Good morning and welcome to another edition of In the Room with the Nate. My name is Steve Backhouse and I'm the host of the In the Room webinar series. And today I'm joined by Sandile Malinga. Welcome, Sandile.
Thank you, Stephen.
Yeah, good to have you and good to be in the M&G Investments offices in Cape Town. I mean, I'm sure you can see there's a lovely view back here. Cape Town is its typical wintry self, overcast, wet, rainy. I'm looking forward to getting home to the cold Joburg, but at least it's sunny this afternoon. So Sandile is a portfolio manager for the M&G Balance Fund as well as the M&G Inflation Plus Fund. And I know you also have some involvement on the global side as well. So I think today our conversation is very much around, well, the topic of our conversation is around inflation. Has inflation peaked? It's a big question. I think a lot of interesting information have come out in the last kind of 10 days or so locally and abroad. But also what we want to get in today is also talk about kind of investment opportunities. So, and inflation is kind of a really important topic and theme, but we want to broaden that out into kind of broader investment opportunities as well. And Sandile, get your views on those as well. Before we get going, as always, a couple of kind of house rules, and I think I repeat myself every time we do these webinars, but they are important. The webinar is an hour long, so 9:30 to 10:30. Sandile and I will chat for about 25 minutes or so, and then at about 10 o'clock or so, we'll actually open the floor to questions. So please post any questions you have for Sandile on the Q&A tab in Zoom, and then I will ask Sandile those questions, and those questions maybe they take us through to the full hour, so 10:30. We will finish 10:30 on the dot. Okay. So I'll make sure we don't go over time. I know your guys' time on the other end is really important, and we do appreciate it. And then lastly, CPD points, ever important CPD points. If you attend the full hour webinar, you automatically get a CPD point. If for whatever reason you need to drop off and you need to watch the recording, which we will send out, then you are able to do that, and then we'll send you a short assessment which you then complete to get your CPD point. Okay, cool. I think that's it from the house rules. Let me just check because I often forget. That's it. So cool. So getting into it, I mean, first of all, Sandile and I were chatting before the start today, and you weren't always going to be a portfolio manager. At one point, Sandile, there was thoughts of being a DJ, and maybe you still kind of got some dreams to be a DJ one day. Is that right?
Yeah, that's. I mean, it was quite interesting. I had a sort of tangential interest in finance in general, but I really wanted to be an artist, and to fund obviously the life of a struggling artist. I thought, I'll be a DJ as well. Obviously to my mum's horror, but she wanted to keep her precious son happy, and wanted to allow me to do what I wanted. Had it not been for the intervention of my maths teacher, Mrs. Maxwell, in high school, I probably would have followed the arts. So thanks, Mrs. Maxwell. If you're watching.
Did you have a DJ name?
No, I can't.
Didn't get that far, eh?
No. My wife
still can.
Look, I still have dreams of being a DJ, but my wife is. I think being sent by my mum to play a rearguard action and prevent that from happening.
Okay. No, good.
But Goldman Sachs' CEO, David Solomon, is my inspiration.
Okay.
He's DJ Soul.
Oh, really? Genuine?
Yeah, he's genuine, yeah. He plays in New York if you want to.
Okay. So you can do both?
You can.
Yeah.
You can.
Absolutely.
Please speak to my wife.
Okay. Convince it. Yeah. Okay, cool. Okay, then getting straight into the topic of conversation. I mean, I think, first of all, let's just get straight into the inflation question. I mean, last week we had a situation, the inflation, SA inflation came out at I think it's 5.4%, which again is down quite nice on the previous couple of months. and actually the SARB decided to keep rates on hold, much to I think some of the consumers' happiness. But then this week we had the US come out. I think inflation is at 3%, and the Fed decided to increase rates. So, I mean, has inflation peaked? And what's your view of inflation kind of going forward?
So it's quite interesting, Stephen. I mean, we were very concerned about inflation in 2022. So if you look at what we did in the portfolios, especially in the global portfolios, we were very underweight duration. We virtually had no government bonds, or very few developed market government bonds.
Yeah.
And the observation was that inflation, what the inflation prints that were coming in versus what the market was pricing in, was massive disconnect. Plus, complicated by the fact that the market was effectively calling central bankers bluff. So if you recall, in sort of January of 2022, US expectations for rate hikes were not even, people weren't expecting more than 200 basis points of hikes.
Yeah.
So, the fact that the Fed delivered 500 basis points tells you there's a massive surprise. And, the market impact of that has been probably the worst showing from world government bonds in 2022. In aggregate, the global Bloomberg global aggregate lost 20%.
So just going back to that kind of the bluff. So someone's saying is like, so the reason rates are increased is to kind of so consumers stop spending or stop borrowing, slow the borrowing down,
Sure.
to kind of, and by increasing rates, indicating that's what you want the market to do essentially. Am I getting it right?
Sure. So the problem was the market firstly didn't believe that inflation was going to be a problem.
Okay.
So 2022 was characterized by upside surprises to inflation, pretty much across the board, except barring some emerging markets like South Africa, where because of the lack of demand, inflation did not surprise as strongly on the upside, and it probably won't surprise as strongly on the downside as well.
Okay.
But in developed markets, you had a situation where inflation kept on surprising on the upside, and the way central banks manage inflation is really by managing expectations, because they can't influence what happens today. They can influence the price of money, which will impact what happens in 12 to 18 months time. So you had the market effectively saying inflation is not a problem, the Fed saying inflation is a problem. Look at the headline prints. I mean, you had 8% prints in the US. Who would have thought, right?
Yeah.
And you had double-digit inflation prints in the UK, which is also a function of some idiosyncratic issues. But in order for the Fed to effect a tightening of monetary policy, they need to increase interest rates, and in sort of fairly crude terms, they're taking money out of the system, out of consumers' pockets, by making their debts a little bit more expensive. And the sum total of that is obviously the cost of capital is going up, and if in simple terms, if the cost of capital is going up, then the hurdle rate for any investment is also going up, and you saw the immediate effect, bond prices fell by 20%, as I said. So has inflation peaked? We don't know. But what we can observe, and we've sort of reflected that in how we've positioned the portfolios, we're a lot more comfortable with bonds in general. For the first time, you're getting paid for, in some instances, bonds actually give you a little bit of insurance. For the 10 years after the global financial crisis, you effectively had to pay for that insurance in the form of negative real interest rates that you're earning on your bonds.
Doing global bonds.
Global bonds. But now you're being paid, 1.5% for buying long-dated U.S. Treasuries. That seems like a fair trade to us. And even if inflation surprises on the upside, say inflation prints at 3% for the next 10 years, your U.S. Treasuries are now, 4%, 4.5% on the short end. You're still earning a decent real return. So we're more comfortable. We don't know whether inflation has peaked or not. Technically, it will come down because of base effects. So simply put, if you look at inflation today and compare it to inflation a year ago, it will have to come down unless, you've got the same growth rate in prices. So it will come down, but whether it's going to come down to 2% is anyone's guess. But the really interesting thing is, what is the market pricing in? And I think the market's been beaten into submission by the surprise rate hike. So now, now we're sort of aligned with the Fed,
Yes.
and other global central banks. There was a little bit of a surprise in SA with the SARB not hiking, but if you look at their statement, and if you look at the voting record,
The voting
it was
is
quite
tight,
split.
Yeah.
So it's
Yeah.
3-2 for
Yeah.
3 for no hike,
Yeah.
and 2 for hike. It could have gone either way,
Yeah.
and the market interpreted that in quite a hawkish way. And even in the governor's Q&A, he was quite clear in stating that if we get any level of discomfort as far as the currency is concerned, as far as inflation is concerned, and if lo and behold we start seeing some upside surprises on growth, they're very prepared to act.
Yeah. Yeah.
Because if you let the inflation genie out the bottle, it's very hard to
yeah. I mean, so obviously, so the locally inflation now is 5.4. And it peaked at, I think, over 7%.
Yeah.
I mean, and that's obviously the 5.4 is inside.
It's inside the target band.
Inside the band, which
Yeah.
is really important.
Yeah.
But I mean, it's towards the upside of the band.
Yeah.
And that's still a possible risk.
Yeah.
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 So again, if it doesn't come out a bit more,
Yeah.
or it goes up, then there's a chance of another rate hike.
100%.
Yeah.
So if you, I mean, if you look at how inflation, behaves, typically inflation expectations will follow, realized inflation quite closely.
Yeah.
So if you want to get inflation expectations down, you need to influence those expectations, and the only way to influence those expectations is to effectively signal that you're going to keep monetary policy tight.
Yep.
Such that demand is going to be kept, because that's the only way they can influence. They can't influence supply shocks,
No.
as the governor stated.
No.
They can't do anything about fiscal policy. So the only tool they have really is on the demand side.
Yeah, and they've
do a good job.
and they got one job,
Yeah.
and they do it
it.
well, and
Yeah.
they're not. Doesn't appear that there's a lot of political influence.
No,
yeah,
definitely. I mean,
Yeah.
a study 2 years ago looked at the credibility of central banks, and they measured it in certain ways. And they found that the South African Reserve Bank is probably the most credible central banks in emerging markets, and the second or third most credible, depending on what the BOE is doing. The Fed's obviously the most credible.
Yeah.
And the SARB is a close second or third. So it's
Yeah. So then I think, but also, I mean, so then everything moves on to our next question. So we're not sure if inflation has peaked.
Yeah.
And then maybe, like, we know, but there's still some risks there. So that importantly for consumers, what we've seen in the last little while, the last kind of 3 years or so, is a lot of investors piling money into kind of cash slash fixed interest type investments, and potentially have actually missed out on real growth. And it's human nature. We see it all. I mean, it's all the time. I mean, so now looking forward, what opportunities are there for investors? And I think about, like, our audience today is our financial advisors, and these are the types of questions that they are getting from their clients. So what are the opportunities that you see kind of going forward in terms of this in these market conditions?
So I think we try and clarify our thoughts quite, and be quite unemotional about it. And a classic case in point is, investing in South Africa and buying South African nominal government bonds.
Yes.
I can't tell you, for the last 10 years, there's never been a report back or speaking to a client where they go, are you sure about these government bonds of yours? But if we look at the return those bonds have delivered, since 2008, the best performing asset class in South Africa has been South African bonds.
Yeah.
They've beaten equities, they've beaten, nominal bonds, I mean, I should be clear.
Yeah.
Inflation bonds have had their own issues, and they've beaten cash. So you have been compensated for taking that risk, which then, to answer your question, we look for where we're being compensated in real return terms. And currently we think South African nominal government bonds are cheap. If you buy a 10-year bond today, you can get 6% real if you hold it to maturity.
Yeah.
That's an equity type return. Cash is actually quite cheap, given that the Reserve Bank has raised rates and is keeping them quite restrictive. We still think South African equities in aggregate are cheap, but there you have to be quite careful in the sort of equities you're buying. And one of the immediate questions people ask is, how can you buy South African equities even though, we don't have growth, we've got load shedding,
Yeah.
and, the municipalities are crumbling, are you nuts?
Yeah.
And once again, it's very hard to do because I live here, so, I go home quite regularly in Joburg, and you guys have potholes all over the place.
No, and but also, and you point like that's what the everyday person
100%.
sees and feels.
Yeah.
So it's not. It's absolutely. It's
Yeah.
like they read the headlines.
Yeah.
They drive on the roads. They go home and there's no power.
Yeah.
I mean,
No, it's crummy. Right?
Yeah.
But
Yeah.
our job is to say, okay, is the current real return expectation that we
Yeah.
think these assets can pay you, does that include all of that?
Yes. So
And
your job is to take the noise out the system.
It's
Essentially,
to effectively go against my instincts, which
Yes.
are informed by me driving to work,
Yes.
me going home, not having lights, and all the associated challenges of living in an emerging market. But our assessment is that the assets are cheap for a reason, yes, but we think they are building in way more than what is the reality.
Yeah.
And a case in point is the Rand, for example. We travel quite a bit, and every time I travel overseas, I feel incredibly poor because I basically have to take whatever rands I have,
Yeah.
divide them by 2, and take off 1 0. So I mean that's like
Yeah.
you
How much does a beer cost in the London nowadays? Yeah, I mean, it's the
I mean £6
Yeah.
for a pint.
Yeah.
It's
Yeah.
expensive.
Yeah.
But do you think that level of the rand justifies the fundamentals? And yes, there'll be massive volatility. So when the rand spiked to 19 over 19 because of the Lady R headlines and the allegations, we had to take a sober assessment and say, one of the things that the market was obviously worried about was there's going to be sanctions, and if there's sanctions, then you're in trouble. You're basically a Turkey or Russia.
Yeah.
And Turkey's not sanctioned, but Russia is sanctioned.
And,
But-
and was it a real threat or a real risk?
It's hard, Stephen, because I'm not trained. I'm not a political analyst.
Yeah.
I don't have any inside info, with the sort of foreign intelligence community or
Yeah.
the like. So all we can do is assess the facts in front of us.
Yeah.
And the facts in front of us suggested, yes, there was some real risk that we'd done something that we shouldn't have done.
Yeah.
But
Yeah. It didn't look good. Yeah.
it didn't look
Yeah.
good.
Yeah.
Right? If you've got kids, so if your son is quiet, and you ask him what are you doing, and he doesn't say anything,
Yeah.
it's pretty problematic.
Yeah.
Right. So we're like the naughty kid.
Yeah.
But the very real consequences of that, our assets, bonds fell. We had one of the worst, weekly and daily performances in South African nominal bonds in 23 years. SA equities paradoxically didn't fall as much. And part of that, we can go into it a bit later on, but part of that is because of the nature of the revenues that some of those companies are earning have nothing to do with South Africa.
Yes.
So there's a little bit of protection there. And the rand depreciated quite sharply.
Yeah.
It's all come back.
Yeah.
So, had you overreacted and said, I'm taking, my little rands out at 1920 or whatever it was, you're feeling a little bit, aggrieved by the whole thing,
Yeah.
because now it's at 1747, I think, this morning, or
Yeah.
1750. So it's hard, especially with volatile markets, to be as dispassionate as we want to be. But that's why you have, your process, and you follow the process, and you try to be true to that, because at the end of the day, that's what delivers.
So it's again, for me, process is really important. You guys, you run clients' money,
Yeah.
precious
Absolutely.
investments. How important is strategic asset allocation to
Yeah.
your process?
So we think about the world, obviously, because we try and not react to noise. You have to broaden your horizon a little bit. So you have to operate, in a sort of medium to long term sense, which is totally unknowable. So how if, for example, you've got a target, you've got a real return target, or your target is to beat your peers, how do you navigate that? And for us, the best way to do it is to, try and come up with an assessment of the expected returns on assets, as well as looking at the risks that those assets have, not just in isolation, but also in aggregate. So if you're buying assets that can fall 20% in a day, are you being compensated for that?
Yes.
If you're buying an asset like an equity which can get totally wiped out, are you being compensated for that? And if you think you're being compensated for that, then how much of that asset should you hold? And that's really all an SAA is. It's like Google Maps. It helps you to get there and shows you the way. But as we know, things can happen along the way, and you might need to deviate from that a little bit. But 80 to 90% of the time, that should help you get there. And if you've done the work carefully, and if you are not totally right, but decently right about some of your expectations.
But I think that's also, again, like often I think investors, we feel that but you got it wrong. It's not actually about but you make such a good point there. You're not going to get it right every time. Okay, but you try and get it right enough times that actually your performance numbers are where they need to be, and you beat your benchmark essentially. Like your goals.
And one of the things you'll find about, especially some of my colleagues, is we don't talk about things like conviction, because I can be as convicted as I like, but is that the right way to invest other people's money? Probably not.
Okay.
And it's not about being right. It's actually about assessing the risks as far as you can, because some risks you don't know, and ensuring that you've got a decent chance of earning those returns, because ultimately that's all we're interested in. We want to earn the returns.
Of course. So you at the moment you said you overweight local bonds, mainly, and those are mainly government. You overweight SA equity. I think you underweight property, if I remember correctly, which is, I think, that we've had a couple of property webinars, and we could have a couple more because people love property, and it's a really interesting conversation. Remind me, foreign equity, you are?
So on the foreign side, it's quite interesting. We went, it's a bit of a journey. So in 2022, we were underweight global equities. Worried about a whole host of things, but the main issue was the valuation wasn't quite right. So it didn't look like it built in a lot of safety in case things turned out as we thought they would. Things turned out even far worse than we did. No one saw Ukraine coming.
Yes.
And Ukraine effectively defrayed the sort of peak in inflation, and actually added another inflation shock to the system. So we're underweight foreign equities, we're underweight global bonds, as I said, and we're sitting in cash. So we had a lot of cash to deploy when things fell out of bed.
And what's the most cash you would hold, like in your balance fund?
On the foreign side or locally?
Both.
So on the foreign side, we're holding around 5 to 7% cash. Which is chunky.
On
the local side, because we'd already deployed it into SA bonds and SA equities, were underweight. But the cash levels were quite high, and the questions were being asked is, why are you sitting on so much cash? If you think these things are cheap, we're like, actually, they could probably get cheaper. And
I mean, I can put cash in the bank. I don't give money to you to hold cash.
And that is what our major challenge, especially with high cash rates, is exactly that. You can go and put your cash in the bank. Hopefully your bank is decent enough to offer you a decent deposit rate. And you'll sleep safely at night, knowing that your cash is safe. Obviously the bank can keel over like we saw in the US, but our banks are very well capitalized and well run, which is part of the reason why we overweight some of the banks. But you're almost 100% guaranteed that you'll get your money back plus the interest at the end. So for us, holding cash, it burns. The technical term is a massive opportunity cost. And if you're sitting in cash, if you sat in cash the last 3 years, you missed out on the equity rally, you missed out on bonds, and global equities, phenomenal run. So getting back to your question, on the foreign side, currently we started buying equities in the middle of 2022, so we went neutral towards the end of the year. Diversified basket, in some instances we quite liked, some opportunities like China. When China fell precipitously in October, we actually bought some Chinese equities in November, and they rallied. So we sold them in January.
Okay.
They sold off again, and we bought them back again. So we're currently slightly overweight China. We slightly overweight some European banks. We slightly overweight some US banks. We slightly overweight.
And are the banks, the bank holding, and let's just keep it on the global side, is that kind of more a cyclical type of holding because of the inflation and interest rates going up?
So at the moment, it's in reaction to market prices in aggregate.
Yes.
On the global side.
Yeah.
It's slightly different on the local side.
Okay.
But we can touch on that in a minute. And we at the same time we're also buying back our developed market bonds. So the area where we are underweight is global credit because we think spreads are too narrow.
Okay.
But we are happy with the level of real yields. We actually overweight some bonds, so we overweight long dated US Treasuries. We bought some gilts, following it wasn't this inflation print, but the previous inflation print. And gilts were behaving like an emerging market, which we know quite well. So we're quite happy to take some of that on. And we also have exposures to some emerging market currencies. Obviously, we don't have the rand so much in our global portfolio, given that 70% of our portfolio is rand based.
Yeah.
But we do have things like the lira, Mexican peso, Hungarian forint, for example, and that is an assessment of the level of real interest rate in that economy. And where the currency is. So it's both a valuation plus a carry story.
Okay. Interesting. Yeah. So then just on to going to local equities. So you overweight. I know you like some of the banks. You mentioned that. And again, is that and that, I think you've already said that's not just a cyclical play. You actually like the business,
the fundamentals.
So
our sort of major picks on the banking side in particular is ABSA, Standard Bank, and Investec.
Okay.
And all of those exhibit three basic things. The valuations are quite cheap.
Yeah.
All three are very well capitalized.
Yeah.
So the way banks operate, they obviously look ahead and say, we expect interest rates to go up by X amount. We think it's going to do this, to our bank book. So we need to provision for the likelihood that some of these loans go bad.
Yeah. Defaults.
And they actually have an ability to adjust their current earnings.
Yeah.
Which is called provisioning to meet those if they do materialize. And through COVID, they effectively put away too much money, and are sitting on pretty healthy levels of capital. And
so then obviously because they've done it, then
in reality turned out a lot better than they expected.
Better, but then also in our situation where they're actually now well prepared for your interest rate hikes, etc. So it's almost like set them up.
Yeah,
so
quite well.
Yeah. Okay.
And in the case of Standard Bank, it's a decent franchise. It's probably the best, Pan-African bank there is, and you're getting it for a pretty decent multiple. The price you put on that is probably around 1.2 times. ABSA, a bit of a recovery story, and they're focusing a lot more on some of the areas where they lost, market share post Barclays divesting.
Yeah.
And you can see it in some of the recovery in some of their metrics. And we expect that to continue. And Investec is also similar, a bit of a structural story. The unbundled then Investec Asset Management.
Yeah.
You had new management coming in. The incentives were better aligned with shareholders, and as a result, you can see the recovery. So they've embarked on massive buybacks. They're consolidating some of the international businesses to make them more efficient. So they all have very nice structural fundamental tailwinds. Plus, you're able to buy them at some pretty decent valuations.
Yeah. I see we got some questions coming through, which I think you're happy we get into those. That's one of the main reasons why we do these. And obviously, so I got 4 questions so far, but I think for for the audience, please keep sending them and bombing them through, and we'll get going now. From Sean, if SA bonds are so attractive, why are foreigners not piling in? What are the risks that they see that local PMs don't?
Yeah, so I can cheat a bit because we manage some global money as well. So I can tell you what we are doing, and I can tell you what my other colleagues are doing. It's an excellent question. So one of the things about South African nominal bonds or South African government bonds in general, if you assess the level of real yield that's on offer, it's quite high. So the only other countries where you're getting a higher real yield from buying government debt, places like Turkey, Russia, the market's closed, Brazil, which has a history of hyperinflation, and other places like probably Thailand, I think, is still offering quite a decent yield. So South Africa, in terms of compensation, looks quite attractive versus its peers. And then we're coming to the actual crux of the question: what are the risks that we're seeing? My global colleagues have actually been buying South African bonds. They bought some bonds in May as the currency sold off and bond prices fell, and actually bought them unhedged. So they actually took dollars, converted them into rands, and bought the bonds. And in this recovery, they're enjoying both the recovery in the currency plus the uplift in bond prices. So clearly they're finding those attractive. And I think the second part of that question is, if you look at non-resident flows into South African government bonds, they have been on a downward trajectory. And part of that is obviously the poor sentiment attached to South African assets, low growth. I mean, the list is endless.
There's also there's a risk factor as well. That's a big part.
Exactly, there's a risk factor.
So as I understand it, and saying is that so obviously you get a nice yield, but you assess kind of that yield with the risk. And if that gets too tight, and especially in when your global bonds are now giving you a positive yield with very little risk, then those are the two things you're matching. Am I right?
Well, the risk is always contingent on the valuation. Right. So in January of 2022, if you were holding a 30-year US Treasury, if you looked at the return of your bonds over 2022, you're down 35% or so. So it's not so risk-free, is it? So yes, foreigners have not been buying South African bonds as much as they have, but if we look at how much of our bonds are owned by foreigners versus other countries, we're still quite high. So it's not as if foreigners have been selling South Africa in particular. They haven't been sponsoring emerging market bonds in aggregate.
But then you got things like your shocks, like you said, the Russian, that type of shock doesn't help us.
It doesn't help sentiment. I mean, it's totally unhelpful. If we can avoid those, we have a good chance.
And it's the same with the Nene Gate.
100%.
It's the same. Actually, the same.
It's the same type of risk. It's just own goals. Well, why would you do that?
Exactly. Always, my wife calls them home goals. Question 2, and Sean, I hope we answered the question. Question 2: how far do you think central banks can realistically go in terms of raising interest rates? So I think maybe what we do here is break it up in 2 parts. I think let's talk the Fed, and then let's talk SA. I think
So globally, the Fed, central banks, current modern central banks, are tasked with fighting inflation. Some have, other mandates attached to it. So the Fed has a dual mandate. They also have to keep an eye on employment. If employment is okay, it's more than okay in the US. If employment is okay, inflation is out of control. They will tighten. Honestly, it's the easiest thing to appreciate.
What are the rates now in the States? They're
at 5 and a quarter, 5 and a half.
Do you know what the highest they've ever been is?
They were double digits. I seem to recall it could be 12 or 14%.
And that's in the last 30 years?
That was early 80s with Paul Volcker. And they were facing double-digit inflation points. I mean, there were a few issues that happened, in the 60s and 70s that led to those shocks. But the sum total of that was inflation was stubbornly high, and the only way to bring it down was to effectively crush growth.
Yeah.
They will do it if that's what they.
They
do not.
Okay.
The one thing you should never do is fight the Fed.
Don't mess with the Fed.
You're going to come second best.
Yeah.
And similarly in SA, if the SARB says they're uncomfortable with inflation at 5.5, they want it at 4.5, take them at their word. They will crush it.
Yeah. Okay. So it's
It's an inflation story. So if you can understand what the inflation dynamic is, and if you can appreciate, is it going to come back down to, post GFC levels, pre-COVID levels? I don't know. I can make an argument for it going back to those levels. So is global inflation going to be around 2 and below? Could be. I can make very good cases for that, and I can also make a case for global inflation being between 3 and 4%.
Yeah.
The consequence of that is vastly different, because there, on the other hand, we can go back to rates being at naught or negative rates. On the other hand, they're going to have to run higher nominal rates, which just lifts the global cost of capital.
Yeah.
And if that's where we're going, you probably have a few more accidents around the wing.
Okay. But the reality is also that, like, where we're at the moment, it does look like things are more under control than they were
a year ago.
I mean, that's
yeah. We and monetary policy operates with a lag. So you're right. You haven't seen the full effect of the rate hikes.
And I actually sort of talked the other day, and one of the things that someone explained as well, which I thought was interesting, is that they'll keep rising rates until they are 100% sure that the inflation is under control. Yeah. Because if and obviously you can have like we did last week, there's a kind of a pause. It doesn't mean you're done. Yeah. But they won't turn the corner and start dropping cutting rates. Yeah. Because if they do that too soon, it actually has the opposite effect. Yeah. And again, they'll err on the side of caution. Yeah. Yeah. And there's a lag.
There's a massive lag.
So actually, by the time they actually get that, they feel that things at a peak, actually, then the thing really is it's on the way down. Yeah. Okay. Yeah. Cool. Another question, they're coming through thick and fast. Thank you. It's a good question from Anonymous. Yeah. How does an SA investor retain international purchasing power, if at all?
Yeah. So
this probably goes to our question that a pound costs six pounds.
Yeah. Exactly.
Yeah.
It's difficult, and empirically, I mean, the rand has been depreciating certainly for the last 10 years in a real sense, around 1.5% per annum.
Yeah.
So you need your assets to do the heavy lifting for you. So if you're in rands, you need your asset returns to at least to be agnostic between global assets and SA assets. You need them to give you more than 1.5% real return to compensate you for that. Yeah. So that's one way. I mean, the other way is obviously, internationalize your money and go offshore, and we're seeing some of that. Certainly in the balance fund space, there's been a massive increase in the allocation to foreign assets by the sector in aggregate. And there, once again, you have to be careful what you're buying, because as we saw, so-called risk-free assets, if the valuation is out of whack, you are facing permanent capital loss. So those effectively, you're broadly the two options you have. And one of the tricky things that we're trying to do is to assess whether, yes, we've had disappointment on the South African equities, for example, over the last 10 years, but do we think that's going to persist? And that's where, you need to do careful fundamental stock analysis on the stock side. Yeah. On the bond side, you have to understand, the fiscal metrics. Do you think the path that one of the most important things to focus on, especially if you're running budget deficits, is your cost of debt and the stock of debt. So do you think your debt to GDP is going in the right direction? And all of those things are things you can quantify and look at, but ultimately you're going to have to assess whether the opportunities available to you will more than compensate you for that, because ultimately that's what you want to do.
Yeah. And I suppose also, I mean, as individuals, to use your what's your foreign allowance allocation that you're allowed to take offshore. I mean, that's
the tricky thing is calling the right level to sell your rands.
Exactly. It's another question, so I'll try up on the order. Okay, so another one from Sean. Why has your inflation plus fund lagged recently versus benchmark and peers? It's a good question. I would have thought the fund would be primed for inflationary environment.
So depending on the period that you're looking at, it's actually not doing too badly versus peers.
Okay.
And it's recovered some of the sort of, we had a patchy period between 2018, 2019, and then obviously 2020, when the fund performance wasn't great, and a lot of that had to do with our allocation to SA property. And inflation-linked bonds, which inflation-linked bonds recovered, but SA property, as you know, hasn't recovered. Recently, it's actually, it's done quite well, so well ahead of peers. We're not making the inflation plus 5 target, and that's a function of, the relatively low nominal returns that we've been able to generate in SA.
But also, my right saying is actually in an inflationary environment, to make the inflation plus targets become actually quite a bit harder.
Yeah, well, it depends. Are you looking at forward inflation, or are you looking at past inflation? And that's, we certainly think assets are priced to give you more than inflation plus 5.
Yes.
Going forward. What's baked in is obviously already baked in. So the fund is currently positioned to deliver some pretty decent returns, and it has been doing that so far.
Cool. Okay, so and then another question from Anonymous. He likes asking his questions as Anonymous. Is consumer debt and credit defaults not on the rise? So won't banks' profits come under pressure? It's a good. That's
an excellent question.
Yeah.
I mean, the South African consumer is, without a shadow of a doubt, under extreme pressure. Partly from rate rises, partly from just generalized inflation increasing, and partly because the economy is not growing. So people are just, high unemployment, wages are not keeping up in real terms. So they're being squeezed, and you rightly should be concerned about levels of debt. There's some, a lot of these surveys are coming out. Depending on the LSM, a lot of people just don't have disposable income. So it's a tough spot to be. And banks, if the eventuality happens that there's a lot of defaults, we think banks are well capitalized, as we said.
And they make the provisions. As you
they've made provisions. They've got enough capital on their balance sheets to meet those defaults. I think the sort of the broader question is really, what does the consumer have to look forward to? It's tough. South Africa has a structural impediment in electricity. So until we sort out electricity, you can't actually talk about anything else, because in order to deal with unemployment, you need to grow. If you can't grow, then you can't deal with unemployment.
But what I'm saying is that we are still a consumer-led economy.
Sure.
And that's again, so if the consumer's under pressure, then the economy's under pressure. And all these things are.
It's all it's all related, and you're just not giving them a chance to fight their way out of a paper bag. So for me, the singular most important thing to sort out is electricity.
And I mean, so again, I was at a talk about a month or so ago, and actually there's a chap at the talk, and he was actually quite bullish around electricity.
Sure.
Okay. So he's just saying is that actually what he's saying is that the ANC has gone and made a call to actually move back to coal. Okay. So we've got coal producing power stations. If they've got to work, but they are coal producing power stations. We've got coal. So actually, because of that, actually, it's one of the reasons at the time load shedding wasn't at stage 4 and 5. It actually just dropped to kind of stage 2, and everyone was feeling a bit better.
The honeymoon.
Yeah. And obviously now we're back at kind of our stage
4 to 6. 4 to 6 is the new 1 to 2.
Yeah. What does it mean? Do you have a view on the power situation. No, it's just, yeah.
We speak obviously to ESCOM, we
Yep.
speak to various ministries, and what was clear at the beginning of this year was that there was no short-term fix. So it's an 18 to 24-month story. What we need to all do, and also to help keep everyone honest and do what they say they're going to do, is to assess whether the things that identified that you need in order to resolve load shedding. The first thing is obviously to ensure that your power stations, the coal-fired power stations that you have, are operating at a respectable level.
And the coal that they're receiving is the right coal.
Yeah, it's not rocks.
Yes.
So they talk about an energy availability factor, which is effectively how much of your power stations, how much of the nameplate wattage are you actually pushing out onto the grid.
Yes.
And we can avoid stage 4 and above if we are generating enough power to give you a 65% and above availability factor. We were there.
Which sounds
It sounds
doable.
reasonable,
Yeah,
right?
yeah.
If I get 65 on my exam paper,
you haven't shot the lights
I
out.
haven't shot the lights
No.
out, but I'm still going to have ice cream for dessert.
Yeah.
So if they can do that, then we're okay. You're still going to have 1 or 2 stages, but it's manageable. And then the second thing is, in order to permanently deal with load shedding, the only solution is to improve once again the reliability of your current fleet. But the fleet is old, so this is the reality that you all have to face.
Yeah.
Our fleet of coal-fired power stations, on average, is between 60, I think it's 55 to 60 years old.
And the new ones have been built badly.
Terribly.
Yeah.
So, and if you look anywhere else in the world where a country has coal-fired power stations as old as ours, they perform exactly the same as ours.
Okay, yeah.
So it's an engineering technical issue.
Yeah.
Right? And we compound it obviously with doing, other things like not building our power stations correctly, self-sabotage, allegations of that. So you need more power. Where's that more power going to come from?
So that's actually, so then what about how the kind of businesses and individuals have then taken it upon themselves to put in solar and that, that has made a difference, surely.
Yeah, absolutely.
Yeah.
I'm sure you've heard this before, but Vietnam
Yes.
installed
They're incentivized.
They installed 5 to 6 gigawatts
Yeah.
of new renewable power in 12 months.
Yeah.
89 to 95% of that was solar PV.
Yeah.
Households, corporates.
Business, yeah. But,
So
the key thing was how they incentivized.
That's
it.
So any flat roof,
Yeah.
you put solar panels. So France today,
Yeah.
you can't build a new mall without putting solar panels on any flat surface. And that's a massive incentive.
Yeah.
Any new building that's going up,
It's actually looking after itself.
It's looking after itself.
Yeah.
So, they're working on that. And I've been on the road a little bit, but I saw they, have released the first draft of new piece of legislation that they're hoping will deal with that. Because ultimately, if you are going to go install a solar panel, you're taking from your after-tax income, if you have, right?
Yeah.
So to pay for a good that you've already paid for.
Yeah. And I'm under pressure.
And
anyway,
I'm under pressure,
yeah.
right? Because interest
Yeah.
rates are quite high. So
Yeah.
you need to help the consumer out there.
Yeah.
And the third thing is ensuring that. So in sort of layman terms, South Africa has a lot of sun, but
Yes.
it's located in the wrong area
Yes.
to where the grid is.
Yes.
So if we put up a bunch of solar panels in the Northern Cape, how do we get those electrons to Gauteng?
Because I've heard the power system, the grid runs north.
Of course,
to south.
because we have coal in Mpumalanga.
Yeah.
So we put coal mines there, we put some power stations there to burn the stuff, and then you ran transmission lines from there
down.
Gauteng, KZN, a little bit to the Eastern Cape, and some of it to Cape Town.
Yeah.
Cape Town, obviously, Western Cape is fortunate in that it has its own power stations. So Kuberg, amazing. And we also have battery storage in the form of a dam.
Yes.
So we have a little bit of self-help tools, which is why on aggregate, typically Western Cape or Cape Town in particular will suffer a level or two below
Yes.
the rest of the country because we can do all of that. So you need to put transmission lines up. The problem is it's very expensive.
Yeah.
So estimates are between 20 and 30 billion rands
Gee.
just to run transmission lines from Northern Cape to Gauteng.
Yeah.
It's almost 4 times that to completely because we need to upgrade our transmission system.
Yeah.
Solar power is not the same as coal power, so you effectively need to retrofit in a way how those transmission lines work and where they're going. And you can't do that. I mean, you have to put the stuff up. I mean,
It's
pylons are massive, right? And it take a while to put up and run lines on there and energize them. So
and it costs a lot of money.
costs a lot of money. So it's not going to happen in
Anytime soon.
unfortunately.
Yeah. No.
And that's bad news for the consumer at the end of the day.
Yeah, and for growth and yeah. I mean, so they're actually got 10 minutes left, so we can fly through it.
Okay.
Yeah. So I'm going to keep going with the questions
Sure.
because I think we're not even halfway through.
I'll try to keep the answers.
No. I think it's all good. Okay, so question from Ben, with the upcoming BRICS summit, there's some talk of our currency being proposed as the alternative to rival the US within the BRICS environment. I haven't heard of that. Maybe you have.
I mean, there's now and again you get this in sort of financial media, I guess. Habitually, there's talk about de-dollarization. I don't know if you remember post GFC, there was talk, that the euro is now going to be the reserve currency of the world. It's a tough thing to do. The reason that there's some technical reasons why it's tough, and one of them is China is going to have to, if they want to do that, because the yuan is going to have to be one of the anchor reserve currencies.
Yeah.
They're going to have to run massive trade account deficits.
Yeah.
It's China. All they do is make stuff and sell it.
Yeah.
I doubt they're going to want to do that.
But also, it's not as simple as going, let's make this an alternative. Let's make the rand an alternative. Almost the market dynamics
Exactly.
dictate.
Who's going to give them the yuan?
Yeah.
So it's an interesting
So it's far-fetched.
thought experiment,
Well,
but
we'll see.
there are reasons why it can't happen overnight.
Yeah. No, absolutely. Yeah. I hadn't heard it. Yeah. Another question from anonymous. Despite high rates in the US, how is it possible that their property residential market has held up and been so resilient?
I don't know if you follow commercial real estate in the US.
No, I don't.
That's under pressure. So one of the reasons SVB
Yes.
collapsed
Yes.
was partly
That's with the Silicon Valley.
Yes.
Yes, the bank. Yeah.
So it was a problem of their own making
Yeah.
because they ran the bank very poorly. But one of the reasons why they got found out was because they had to revalue the assets on their balance sheet, and predominantly those were commercial real estate assets. With higher interest rates, the values are going to go down, and you need to have the capital to meet those write-downs. They didn't have that, and it's sort of rippling underneath the surface.
Yes.
And post-COVID, I think there's been a structural change that's now been compounded by interest rates, where the nature of commercial real estate is changing, you need to find a new equilibrium between the supply of commercial real estate and the demand of real estate. That has to come via some pricing mechanism. But what you're seeing now is, cities like New York, San Francisco, there's massive vacancies, especially in, anything that's not, prime. So anything that's
Yes.
not new.
Commercial
modern,
vacancy.
Commercial vacancies
Yes.
are through the roof.
Yes. But like Joburg is not far off from that. I mean, that's
Sandton is.
Yeah, I mean, you look at, I mean, not, again, I know it's not the US, and the question actually about residential, but Joburg, is it, and actually so there's a road called Fricker Road.
I know Fricker.
You know, I mean, it's 10 years ago, Fricker was
Pumping.
a hub.
Yeah.
You drive through there now, and there's just to let signs
empty,
everywhere.
yeah.
And it's just that the buildings now are
Empty.
seen as being old and inefficient.
Yeah.
And you'd rather move into a new modern building
Yeah.
in a Rosebank or a Sandton, which is more efficient and more central.
But now it's
Yeah.
it's much harder to finance that because interest rates are 500
Yeah.
basis points
Yeah,
higher.
yeah.
On the residential
Yeah.
side, on the US, you're starting to see a little bit of pressure. So new home
Okay.
sales have started to taper off. The issue once again is, unlike in the UK, mortgages in the US are fairly long dated.
Yes.
So the effect of interest rate hikes is going to
Yeah.
take a little bit
Yeah.
longer. But you already see it in new homes that need to be financed for new mortgages.
Is it also maybe a factor that, I don't know, for example, like in places like New York, your demand is just so high,
Yeah.
and then actually the rentals I've read it are just through the roof.
Yeah.
Yeah, but again, it's more like those nodes that are actually good, but it's more supply and demand situation.
Yeah.
But like Cape Town, probably. If you
Well, yeah, exactly.
Actually, if
Yeah,
you think about
so-
it, all the Joburgers moving down here.
Oh, jeez.
Yeah. Come to ruin your roads.
Oh, no.
A question from Warren. If a GOA is withdrawn or adjusted at all, it's a good question. What implications for SA specifically? Is a withdrawal a real possibility?
Yeah, I mean, to be fair, I don't know much about a GOA and that negotiation process and where it is.
Yeah.
But you can imagine if it's one of our major sort of trade pacts.
Yeah.
And if that goes, it's a problem. There's
It has to be.
how much of a problem it is, I'm not sure.
Yeah.
I can go have a look at some of the estimates but it's not going to be a nothing burger. It will have an effect, but I think the longer term effect is the international community's view of South Africa. If you don't want to be seen as a pariah state, especially by two of your biggest trading partners,
Yes.
which is the European Union and the US. So it definitely will have an effect, and it's once again an own goal that probably should not have been.
But the fact that
incurred.
Putin's not coming. That's been the calls he made. He's not coming to the BRICS summit. Now that's a good call.
Well,
Sure.
he shouldn't have been invited.
Shouldn't be invited.
Yeah.
No, exactly. That's the own goal. Spot on. And you can see that all these things
Yeah.
are all related.
Yeah.
Yeah. Politics.
Yeah.
Real world politics.
Real politic, as they call it.
To our politics, and we literally have got 3 minutes left.
Okay.
What's your view on the US election next year?
It's a scary
And
process.
does it affect your thinking about how you run your portfolios?
No.
Okay.
Partly because we try as much as possible to purge any views coming into the portfolio. If it's not backed by the fundamentals, the valuations. So we're currently underweight US equities,
Yeah.
but it's a valuation call.
Yes.
We're not, even thinking about elections, partly because, one of the things about forecasting is there's two major problems, very different, but all not good for you. You can be very wrong, which happens incredibly with a high chance.
Yeah.
You can be right, but the market reaction can be wrong,
Yes.
or in your eyes can surprise you. Right?
Yes.
The market will do what the market does. A case in point: Trump was elected in 2016. If you recall, the S&P was falling into November, and I think the low point was probably the first or second week of November. Trump is elected, things are going to be absolutely horrible, and then what happened? The market rallied 40% from there.
Yeah.
So you might have gotten Trump's election right, and you might have said, okay, so I'm worried about equities, US equities, I'm going to sell all my US equities,
Yeah.
and you're in trouble. So it doesn't impact, but the assessment, we're going to have to see what it means for American trade policy once again,
Yeah.
what it means for, some of the, frankly, cracker stuff that they did, if they're going to bring that back, what effect is that going to have on the economy? The Brexit is a case in point where bad government policy can have a very real effect
Yes.
on the economy. So,
Yes.
Brexit, one of the things that have been a consequence of that is obviously migrant labor in the UK. They're still coming, but it's not enough to meet the demand. So you've got a shortage of labor, which then means you can't operate your businesses at the level that you want to operate. Your labor costs are going through the roof because now everyone's fighting for the same labor, and that's why one of the reasons to explain why UK inflation is higher than US inflation.
Okay, yeah.
So we're gonna have to watch it and see, but I'm not going to sell my US equities because they elected Trump.
Yeah.
It's just not.
And the reality is, he's got a chance. He's a real chance.
That's what's scary about it.
Yeah. I know.
I've got family there, so it's not great.
Okay, it is past, so we are gonna call it. So first of all, Sandile, thank you very, very much for your time.
Thanks
really appreciate it.
It's been great.
I've seen while we're seeing the weather's coming even more.
I try to keep the rain away as much as possible.
It's great to be here with yourself and M&G. So really appreciate it.
Thank you for having us.
Just from our side, thanks to everyone who dialed in and listened, and thanks for the great questions. I think just last reminder, CPD points, as I said, if you're here for the full hour, you'll get it automatically. If not, there'll be a short assessment you'll do that you need to do for your CPD point. And I think that's it. Sweet. And thanks very much. Cheers.
Have a lovely weekend.
Innate is a registered trademark of Stanlib Wealth Management Pty Limited, an authorized financial services provider.